Hello and welcome to the Global View on this Tuesday. I'm Andrew Gagan. Good to have you with us again here at AusBiz. Let's get across what happened overnight. Global stocks dragged lower by fresh uncertainty over US trade policy. That is, of course, after President Trump imposed a new 15% tariff in the wake of a Supreme Court ruling. That's a universal tariff. So stocks on Wall Street tumbled, led lower by software and financial companies, with the losses most pronounced on the Dow. IBM led those losses, while Amex and Visa also fell heavily. JP Morgan, Goldman Sachs, Citigroup among those banks lower, with UBS strategists saying that AI disruption is expected to intensify over the next 2 years and markets could be heading for a credit crunch. Software companies came under more selling pressure after broker Jefferies downgraded stocks, including Workday, DocuSign and Freshworks. Shares of Atlassian also tumbling. And the healthcare index advanced, boosted by a gain in Eli Lilly after rival Novo Nordisk's obesity drug underperformed Eli Lilly's drug in a head-to-head trial. Among the other movers, Domino's climbed after the fast food chain's fourth quarter same-store sales beat estimates, and PayPal jumped on news that the payments firm is attracting takeover interest. Well, President Trump has warned countries against backing away from recently negotiated trade deals with the US after the Supreme Court struck down his emergency tariffs, prompting him to impose a 15% universal tariff. Posting on social media, the president said any country that wants to play games with the ridiculous Supreme Court decision, especially those that have ripped off the US for years and even decades, will be met with a much higher tariff, and worse than that, which they just recently agreed to. Buyer beware. Well, US data shows factory orders in December fell 0.7%. The Dallas Fed manufacturing activity index rose slightly. And a powerful blizzard has frozen America's northeast, bringing travel to a standstill while thousands of homes and businesses were without power. Well, President Trump's tariffs have infused new risks and uncertainties into trade policy, as well as US debt and the US dollar. The Supreme Court ruling making no decision on refunds, with revenue raised so far by tariffs running above $175 billion. The US 2-year Treasury yield fell to 3.44%. The 10-year was around 4.02%. Australian 3-year government bond yields at 4.26%. The US dollar index is up slightly on the days, along with safe haven currencies. The Aussie trading at 70.5 US cents. Oil prices eased, but remained at 6-month highs ahead of a third round of nuclear talks between the US and Iran, and amid increased economic uncertainty after the tariff upheaval. Brent crude futures down about 0.5% at just over $71 a barrel. Gold has risen 2.5% to a 3-week high, propelled by a fresh wave of safe haven demand on tariff uncertainty. Spot gold sitting comfortably above $5,200 an ounce, and copper is off slightly. Iron ore is up to $98 a tonne, and Bitcoin has fallen below 65,000 US dollars. So let's unpack all that movement, particularly stateside, in particular with a focus on those tariffs and the impact that is having on markets. Steve Sosnick is joining us from Interactive Brokers. Steve, welcome. I should note too that we're noting that how cold it is your way, and you are buried under snow. So thanks for taking the time to talk to us this morning. So let's go to the tariff situation then. Look, surely the president knew this was coming. Was this part of the playbook then, that he had this as a backstop, that he would impose this 15% universal tariff?
Good morning, Andrew. I think the 10% tariff was probably in the playbook, considering how quickly that was rolled out. Then the 15% part, though, I think caught a lot of people by surprise. It was almost, someone asked me, is it capricious? Is it vindictive? Is it, where did this come from? Why? How do you change your mind that quickly? But that's not a good thing if you're trying to establish some clarity around how tariffs are going to be implemented and operating. What we have now was, the Supreme Court struck down the main tariff authority. There are other venues through which the president can go. He instituted the 10% tariff pretty much immediately, which makes me believe that he was expecting it. Markets were expecting it. There was about a 75% chance on prediction markets that the Supreme Court would overturn it. And the one that he went to has a 5-month extension, basically, on the tariffs. But that gives them 5 months to think of something new. But it was very distressing, not so much to see the 10% because we rallied on that, but it was the 15% afterwards that definitely made people say, what's going on here, and what is the path forward, and it remains uncertain.
Well, to the point that, for instance, the EU is saying it's not going to accept that increase. And we have seen, obviously, given it's raised to 15% in Australia, for instance, we're at 10%, so that's a hit for us as well.
It's a hit for you. It's actually a boon for China and Brazil, ironically, which are two of the countries that the president has sort of the most trade angst with, because their tariff rates were higher. At some level, this has to frustrate him because I think he was using the carrot and stick approach of tariffs as a way to get countries either to the table or to do what he wanted them to do from trade negotiations. And it's a lot harder to do if you just have this blanket 15%, and it really hamstrings his ability to negotiate. He likes to make deals, and this is one of the ways that he could have leverage over deal making. And to a certain extent, that's been taken away. And I think that was sort of the frustration that he was echoing in his comments since the Supreme Court ruled.
So, Steve, how do you see investors playing this, combined with, of course, what we're seeing in tech, particularly that sell down of software stocks, and that has continued?
The mood is very skittish right now. The question I got asked the most was about a report from a firm I'd honestly not heard of before, Citrini Research, who basically laid out an apocalyptic scenario for how AI was going to essentially kill the software industry, then kill the financial industry, then kill companies that rely on customer loyalty, basically, because agentic AI won't have that loyalty. I didn't read the report. I don't know the people, so I didn't have access to it. But that's the sort of unhelpful reminder that's out there, and the fact that you saw stocks like American Express, Capital One down like 7 and 9% today. And then there was a story that came out that Anthropic was able to, have an AI program that did COBOL programming, which is an obsolete language that still exists on a lot of old IBM mainframes. And that took IBM down 13%. That's the biggest fall in decades. So it's telling us that there's a very, very skittish mood out there about AI. It's really under the surface. And the question that really bugs me right now is, how many of these hits can we take to various sectors before it really starts to impact the market as a whole? You can only hit certain, so many sectors so hard for so often before it really takes its toll. We're still holding above the 6,800 level in the S&P 500. So as of now, I can't say that the pattern we're in is other than consolidation and a trading range between, call it 6,800 and 7,000. But certainly we're seeing a lot of underlying volatility. I've heard it described as a minefield or driving through potholes. It's a very difficult way to invest right now when you see this volatility in underlying stocks and across sectors.
All right, so we've got that sustained pressure. You were saying perhaps to the point where the market may well crack. How do you position yourself as an investor? How defensive do you need to be?
That depends on your risk tolerance and how you're invested now. I think it behooves you to be considering lower beta stocks. I think it gets investors to really be thinking about markets outside the U.S. Obviously, I know I'm speaking to an audience outside the U.S., but I think a lot of people around the world have become enamored with U.S. stocks. Maybe some of that love affair, needs to be focused more on home markets or other markets, diversification. So low beta, diversification, dividend yields, dividend yielding stocks, as long as those stocks pay dividends out of free cash flow as opposed to borrowing money, which has become a problem from companies with significant free cash flows among the tech sector, which did not pay big dividends, now borrowing immense amounts of money for build outs. And so that's really the way. Or quite frankly, You saw the move into fixed income today in the U.S., and I think hiding in fixed income that can pay you 4% or more is not a bad thing either.
What do you buy into this point that perhaps Bitcoin is somewhat of a leading indicator here, given what we have seen more recently, but perhaps a sign of what is to come in equity markets?
I do. I've seen Bitcoin acting as a proxy for risk, and for risk, and it hasn't been. The problem with Bitcoin, has been that it's not real. What is it doing for you now? It's not. It's certainly not acting as a hedge. It's been correlated with the Nasdaq quite heavily, and it remains so. It's certainly not acting like digital gold. Actual gold is acting as a nice hedge. It's not the focus of where investors are moving their money anymore. We've seen these digital asset treasury companies, which were the true vanguard of risk assumption in crypto, some MicroStrategy, Bitmine Technologies, those kind of companies come off hard. At this point, even though we have an administration that professes to be very crypto friendly, a lot of that is focused more on stable coins than on the coins themselves. And I think that we're just seeing that as a sense of people taking profits if they have them, or losses if they have them, and moving out of crypto and into other sectors, because Bitcoin has just been this risk proxy, or a liquidity proxy, and neither is really working its way right now. And there's not a compelling reason for people to continue to put fresh money into it, with the exception of those people looking to try to find a buyable dip or a bottom.
So much to watch and consider at the moment, Steve. Stay safe and warm. Thanks for joining us from Interactive Brokers.
Will do. Thank you, Andrew. Take care. Bye-bye.
All right, let's check the local market ahead of the open here. And we're looking for a positive start. That's despite what we have seen on global markets overnight. And of course, a big focus remaining on earnings season. Lots of results to get through again this morning. We'll do that in just a couple of minutes. Stay with us for the open.